Hello, welcome to the last module 10 of the course Personal Finance. Thank you for staying true from module 1 to this point, and I believe that it has been highly impactful and informative, and that you are beginning to experience transformation from your mind as it relates to handling or personal finance management. So, module 10, we are looking at advanced financial strategy and mastery. So, in this module, uh, we will understand the modern evolution of wealth management, emphasizing that financial mastery is far more than stock selection or insurance coverage. So, we'll look at how to engineer a complete financial system that integrates human capital, financial capital, tax strategy, risk management, legacy planning, and global consideration. So it's like putting everything we have been learning together in one piece. So let's look at balancing work wealth and bank wealth. The foundation of advanced personal finance is understanding that total wealth comes from two main sources. Total wealth, complete wealth come from two main sources. Number one is human capital, and the second is financial capital. Human capital is your future earning ability, while financial capital is your accumulated assets. The goal is to gradually convert earning power into invested assets for long-term financial security. So let's talk about human capital. Human capital is your work wealth. The human capital is your work wealth, all right? So it is the total value of all the income you are expected to earn over your remaining working years. So if you are early in your career, for instance, this amount can be very large because you still have decades of employment ahead of you. In practical terms, your education, skills, experiences, health, and professional reputation all contribute to your human capital. And don't forget, I say human capital is your work wealth because they determine how much income you can generate. So financially, human capital behaves similarly to a bond because it produces steady and predictable payments in the form of a salary. Then let's look at what financial capital is. While human capital is your work wealth, financial capital is your bank wealth. The assets you have accumulated and invested, including savings, stocks, real estate, and even retirement accounts, all these form your financial capital. It is tangible and accessible, but exposed to market fluctuations. So the value of your financial capital depends on how wisely you invest and manage risk. So over time, consistent saving and disciplined investing allow financial capital to grow, eventually becoming large enough to replace the income that once came from your job. So you have to set a balance between your human capital and your financial capital. Again, what it means is, in other words, you have to balance your work wealth and your bank wealth. Now let's look at life stage financial evolution. Your financial strategy should adapt as your human and financial capital evolve through different life stages. So as you continue to grow, as your finance continue to grow, as it continues to evolve, your human and financial capital evolves. So your financial strategy should also begin to change. All right? So this dynamic balance dictates your risk tolerance and how you invest. Now let's talk about when in your early career. In your early career, you have high human capital and low financial capital. You can afford higher investment risk as your job acts as a safety net. But when you are in the mid of your career, there will be decline of human capital, that is your work wealth, grow, but your financial capital begins to grow. So a balanced approach is important. You know, when you need to have a balanced approach to risk, focusing on both growth and capital preservation. Then when you are very close to retirement, your human capital will be low, but your financial dependence will be high. So the focus shifts to stability and income generation with critical protection of accumulated assets. Then when you reach retirement, no human capital because no work wealth. At retirement, no human capital or no work wealth. But financial capital is the main income source. You have very low risk tolerance and you focus on steady cash flow. So the core principle is converting human capital into financial capital over time, ensuring your investments eventually supports your life. That is why it is good to start your career early. You have to start your career early in life. Now let's look at what asset location is and why it matters. So advanced portfolio strategy includes asset location. You know, focusing on where investments are held to maximize tax efficiency. This can increase long-term returns by about 1% annually, without additional risk due to compounding and varying tax treatments. So there are three aspects we will consider: taxable accounts, tax deferred accounts, and tax-free accounts. So taxable accounts are best for tax-efficient investment like broad market index funds or municipal bonds, which generate minimal ongoing tax liability. But tax-deferred accounts are very ideal for income-heavy investment like bonds, REITs, high dividend stocks in 401ks or traditional IRAs, shielding yearly income from immediate taxation. Then the third one is tax-free accounts. Tax-free accounts, you can invest in tax-free accounts. Roth IRAs or Roth 401ks are best for high growth investment, as qualified withdrawals and appreciation are completely tax-free in retirement. Now let's talk about advanced portfolio building. Advanced portfolio building. Now, moving beyond the traditional 60-40 model, sophisticated strategies align investments with real-world goals and balance risk more precisely. There are two key approaches, and they are liability-driven investing, LDI, and risk parity. Now, there is a need for me to explain these two. Let's start with the first strategy for advanced portfolio building: liability-driven investment, LDI. LDI focuses on meeting specific financial obligations with certainty. It matches assets to liabilities, ensuring funds are available at exact future dates, for instance, tuition payment. This minimizes market volatility, exposure at critical moments, and also protect against sequence risk. But let's look at what risk parity is. Risk parity are allocated based on risk contribution, not just capital. It equalizes the volatility each asset contributes to the portfolio, often by allocating more capital to less volatile assets like bonds. This creates a more balanced risk structure, and it aims for consistent performance across various economic environments. So these two strategies are important if you want to build an advanced portfolio. Now let's talk about the use of advanced tools. Advanced tools and why they are important. So, serious financial planning uses probabilistic modeling to stress test plans under thousands of scenarios. You quantify uncertainty rather than relying on simple projection. This measures a plan's resilience across many possible futures. So under this, you will learn scenario modeling, risk assessment, and strategic adjustment. Now, in the Monte Carlo simulation, he talk about the financial weather forecast. So this technique runs a financial plan thousands of times using random market returns, inflation, and lifespan assumptions. It incorporates volatility to reflect real market behavior, providing a success score. For instance, when you say 90% probability of success, what you are giving is you are giving a forecast to identify plan weaknesses before they become real problems. Now let's look at professional planning software. If you want to plan your finance, there are softwares that can help you. So these softwares are just specialized platforms that perform complex simulations, integrating tax laws, estate planning, and investment strategies to model dynamic scenarios in real time. Examples of such planning software include eMoney Advisor, Money Guide Pro, and Right Capital. So these tools quantify uncertainty, shifting planning from guesswork to probability management, ensuring your strategy remains strong no matter the future. Now, after making wealth, there is another thing about wealth. You have to preserve wealth. Wealth preservation. It means protecting what you now have. Building wealth is only half the equation, but preserving it is equally critical. So, wealth preservation focuses on protecting your accumulated assets from market shocks. You protect your assets from taxation, even from litigation and inflation and other high impact events. Okay, so wealth preservation emphasizes resilience, structural protection, and risk containment. So in wealth preservation, we'll talk about risk management, asset protection, and umbrella insurance. Now let's look at legacy and giving. Now, when you have built wealth and you have gathered wealth, that is not just enough. You have to also set a legacy. You have to engineer your impact. All right? So that's what we are looking at now. So true financial sophistication extends beyond asset accumulation. All right? So philanthropy, when engineered properly, functions as structured capital deployment. You can begin to donate. You can go into donor advised fund and also form a foundation where you now begin to support people. A donor advised fund is a charitable account established within a sponsoring public charity. Once a contribution is made, it is legally irrevocable. However, the donor retains advisory privileges over investments, allocation, and grant recommendation. So, at this point, you now begin to think of establishing a legacy through your giving. All right? You begin to support foundations, support less privileged to ensure that they are also helped financially. So, it's not just about making wealth, but it is about using your wealth as a tool to engineer your impact. Now let's talk about global awareness. Financial markets are deeply interconnected. It requires deliberate global risk framework, all right, such as geopolitical hedging and cross-border tax compliance. So maybe you are doing business and what you are going into transcends between will involve other countries. You have to be aware of their policies. You have to be aware of their laws. You have to be aware of their tax charges so that you will not be trapped. So this is what is helping successful investors. So you can see that Module 10 serves to bring all those other concepts together and woven it into an integrated system. So advanced financial strategy is all about creating an integrated system rather than simply accumulating money, accumulating assets. So when you understand this interplay we just talked about, it will help you a great deal to know how to create and integrating system. All right. So, mastery of your finance lies in treating wealth as a dynamic, adaptable system where every choice contributes to a durable, purposeful, and intergenerational financial plan. I hope you enjoyed this course, Personal Finance, and I believe that you will put it to practice so that you will enjoy financial freedom both now and also in the future. Thank you for listening.